PM Panda here. 2.5 decades delivering projects, PMP certified since 2003. The mistake I'm about to show you is how budgets really die. Have you ever had your project budget wiped out because you completely forgot to include corporate accounting fees? It is a gut-wrenching feeling to deliver a technically perfect project only to find out you actually lost money. Today, we are going to fix that by mastering the difference between direct costs, project overhead, and G&A fees so your margins never vanish again. You meticulously price out every piece of material and negotiate the best subcontractor rates until your direct labor is perfectly tracked. You report to the sponsor that you are completely under budget and everything is looking green. Then, finance hits you with the final ledger, adding a massive 30% charge for unallocated overhead and corporate general and administrative fees. The absolute shock of watching a highly profitable project instantly plunge into the red because you only managed visible costs is a career-defining mistake. You were managing tasks, but you were not managing the true organizational cost. To survive this, we have to start with the basics of direct costs, which are the controllable foundation of your baseline. Direct costs are resources directly attributable to specific project work and are easily traced to a specific work package in your breakdown structure. Think of materials, equipment, and the labor specifically hired to build the product. As a project manager, you have high control and influence over these expenses because they only exist if the work is being done. If you stop the work, these costs generally stop too, making them the most predictable part of your budget. The reason we love direct costs is that they are tangible and logical. When you buy 1,000 tons of steel for a bridge or hire 5 developers for a software launch, you can see exactly where that money went. In professional certification exams, they often test your ability to distinguish these from everything else by asking if the cost can be uniquely assigned to a specific task. If the answer is yes, it is a direct cost. This is the primary area where you can negotiate and drive efficiency to save the project money during execution. Now we enter the danger zone of direct project overhead, which represents your hidden burn rate. These are project-specific support costs that are tied to your deliverables but are not the deliverables themselves. Examples include my salary as the project manager, the rental fees for a temporary site office, or specialized software licenses used only for this duration. You have moderate control here, but here is the catch. These costs are time-dependent. If the project finishes early, you save this money, but if you run late, the meter keeps running every single day. Most junior managers fail to realize that direct project overhead is essentially a tax on your schedule. While you are busy arguing over the price of a pallet of bricks, the rent on your site trailer and the salaries of your support staff are quietly eating your contingency reserve. This is why finishing a project on time is not just about the schedule, it is about stopping the bleed of these temporary support costs. In my experience, ignoring the overhead burn rate is exactly what kills delayed projects that otherwise look healthy on paper. Then we have the corporate tax, officially known as General and Administrative Overhead, or G&A. These are organization-wide support costs that are allocated across every project in the company. We are talking about corporate accounting, HR services, executive salaries, and general advertising. You have absolutely no direct control over these allocations as a project manager. They are the costs of doing business as a legal entity, and your project is expected to pay its fair share of the lights staying on at headquarters regardless of your performance. G&A is usually applied as a flat percentage by your finance department at the end of the month or the end of the project. It is the silent profit killer because it is often invisible until the final accounting reconciliation. If you do not account for this 10 or 15% hit when you are bidding or budgeting, you are effectively lying to yourself about your profit margin. Professional managers know to ask finance for the standard G&A rate before they even start their first estimate, ensuring the corporate tax is baked into the cake from day one. Let's talk about the mechanism of how this breaks, specifically when we look at the triple constraint. When project managers decide to crash a schedule by adding resources to speed things up, they usually only look at the increased direct costs. They see that adding more labor costs more money, and they hesitate. However, they fail to calculate that shortening the project duration actually saves a massive amount of money by reducing the indirect project overhead that accumulates over time. Sometimes, spending more on direct labor to finish early is actually the cheaper total option. I once saw a team refuse to pay for an extra shift of labor because it was too expensive in their direct cost budget. By saving that $50,000 in labor, they ended up extending the project by 3 months. During those 3 months, the project overhead for the site office, security, and management salaries cost the company $200,000. They saved $50,000 in direct costs, but lost 4 times that amount in unmanaged overhead. This is the trap of looking at the budget through a straw instead of seeing the whole organizational picture. Let's look at a worked example involving an international hospital construction project. The project manager was managing a specific $100,000 phase and was aggressively tracking the $70,000 allocated for materials and contractor labor. This was their direct cost baseline, and they were hitting it perfectly. However, a series of severe weather events delayed the project by 2 months. Because the manager was hyper-focused on the contractors, they completely ignored what was happening to the other 30% of the budget during that idle time. During those extra 2 months of delay, the project continued to bleed cash. They were paying for the temporary site office rental, the project manager's own extended salary, and the corporate HR support allocations for the team. While the direct labor stopped because the contractors couldn't work in the rain, the overhead did not stop. For every day the site was empty, the project was still being billed for the fixed costs of existence. This is where the budget actually died. Not in the cost of the bricks, but in the cost of the time. By the time the hospital phase was finally finished, the delay had not just cost direct labor. The unmanaged overhead bleed had completely bankrupted the contingency reserve. The project manager was shocked to see the final bill because they thought they were on track. They forgot that every project has a daily cost of living. In my experience, I have seen a delayed event site bleed so much cash through unallocated overhead that the entire profit from the event tickets was gone before the doors even opened. Here is what most people get wrong after 25 years of me watching this nonsense in the trenches. They assume that direct costs are the only costs that matter. They submit a budget based purely on the work breakdown structure's labor and materials, leading to massive budget shocks when corporate finance automatically hits them with the G&A overhead at project closure. If your budget only includes what you can see on the site, you are missing half the story. You must account for the organizational weight your project carries. Another common mistake is ignoring indirect costs during schedule compression. If you are studying for your professional certification exams, remember that crashing a project increases direct costs but decreases indirect costs. If you only talk about the cost of adding people, you are missing the financial benefit of finishing early. A pro manager calculates the net effect. They know that sometimes the most expensive labor is actually the cheapest option when you factor in the saved overhead from an earlier finish date. To wrap this up, remember that direct costs like labor and materials are easily traceable and highly controllable by you. Direct project overhead, like your own salary and site rentals, is tied strictly to the project's duration and requires tight schedule management to control. Finally, G&A overhead is the uncontrollable corporate allocation that you must account for even if you cannot change it. If you master these 3, you will finally stop the mystery of why your project margins keep disappearing at the finish line. Your actionable next step is to open your current project budget today and verify exactly what percentage of your total cost is allocated to G&A versus direct project overhead. If you cannot find those numbers, your finance department has a surprise waiting for you that you probably won't like. If this breakdown helped you see the hidden side of project finance, hit like so I know to make more. Subscribe if you want practitioner lessons every week from someone who has been in the trenches.